Hi guys, we see that there are people joining. We're gonna give you 3 minutes, 3 to 5 minutes until we start, that more people sign up. So yeah, let's wait for a bit. Okay, let's give it a couple of minutes until we start. I see some old known faces among the participants. That's good. Perfect. Let's wait a couple of minutes yet. A minute. Team. Okay, I think we can get started. So thank you very much for joining, guys. I guess some other people will join in the middle of the talk. First of all, well, this is our first webinar in this year. In fact, this last Tuesday, we were going to have a webinar as well with Jordi Vidal from Kibo Ventures, but that one was postponed to next Tuesday. Unfortunately, the last minute, we needed to change it. And then, well, so it doesn't matter. It was for operational reasons, but in the end, we're going to have the exact same webinar next Tuesday. I hope also that you guys can make it if you are interested. So we decided to have that webinar more from the venture capital side to see their point of view. And this webinar today is more from the startup side. So as you guys know, and well, we will cover in this webinar, there's a different atmosphere in terms of venture capital money. So we think that it's particularly relevant now to see like what we need to prepare financially for 2024, both in terms of funding and in terms of operating your own company. So I guess in terms of funding, in both of them, in terms of getting funding and in terms of handling your company, of course, there are best practices that always apply. Regardless of the economic scenario, you always need to, we always say, aim for the optimistic case, make decisions based on the base case, and finance yourself for the worst case. That always applies, and the best practices of financial management of a startup always apply. Although this year is a little special due to like, okay, let's see what the pessimistic case is, let's see what the optimistic case is, and adjust both our funding strategy and our handling or managing strategy in according to it. So we will cover, well, first of all, who are we, in case you guys don't know us yet, in the Startup CFO. Then some wrap up of the venture capital industry in last year, and then tendencies for this year, 2024. Then financing alternatives to venture capital, and then we keep going down from like trends to funding to managing. What's the most relevant KPIs to track in your startup, and what should be the structure of your own team. And then at the end, a summary on the best practices of all of this. And last but not least, we're going to talk about the next academy courses that are starting about venture capital and about startup finance. So this academy, as I will mention later, we have already done 7 editions so far of our courses, and we'll give you a little more insights, especially on the course that it's starting next week, in case you guys have any doubt, want to sign, or are interested. So I leave the floor to Juvenal Cubiles. Juvenal, he is the CFO director here at the Startup CFO. By today, he's in touch literally with over 50 startups, almost on a daily basis, like live now, like that are active clients. So I think he has one of the best possible perspectives from the startup side on these topics, like what are the general trends, what are the funding alternatives, and how to handle the startup and everything related to finance on a day-to-day basis, depending on your stage. So I leave the floor to Jubi, and we can get started with the content.
Okay, well, thanks a lot, Jaime, for the nice words and for raising the bar for today. Yeah, so we will cover this content. Any questions you may have, please feel free to interrupt me. If you raise your hand in Zoom, maybe I can't see it, so just feel free to open your mic and ask directly. Okay, the main idea is for you to understand what we have seen in 2023, what we can expect in 2024, and the different options and the different takeaways we can have in this year. So feel free to ask again. Okay.
Yeah. Also, you can ask questions either in the chat or raise your hand or opening your microphone, as Jubi was saying. Whatever means is easier for you guys.
If we make it dynamic, it's going to be even better. Okay, not just me speaking by myself. So who are we? We are the Startup CFO. We offer fractional CFO services for startups. We have offices in Spain and in Germany. So our main business is in Europe, although we have startups or clients all over the world. We also have other business lines that support very well the fractional CFO services. We're currently more than 25 people in the team, work with more than 200 startups all over the world, in more than 20 countries, Africa, America, Asia, and we are currently serving more than, well, maybe more than 100 in total. Okay, so as Jaime said, this gives us a really good vision over the current situation in the market and historical evolution, because we have been around for a few years now, and we are exactly in January is when every startup is building the business plan, looking to the numbers, both on our reporting from the last year and what we can expect in terms of business for the following one. So it is the best moment to plan and to decide what we're gonna do and what we're gonna see in the coming months. Okay, you have here the links for Academy and our YouTube channel. There you will find a lot of content for different areas in startups, especially in finance. Okay, so let's cover first of all what happened in 2023. In terms of investment, okay, we have seen fewer rounds and smaller in size. Okay, we will see this later in my graph, but what we have observed during the year is that funds are not that active in investing. There's a lot of analysis before putting the money. They're not willing to give such high valuations as we saw in the past, especially in 2021 or until 2021. and the size of the rounds are smaller. So we have seen that startups have got into the survival mode. This is how we call it, meaning that a lot of bridge rounds from existing funds have occurred because startups are looking into raising big rounds in the future, but they have to get until then. So the way they are willing to do it is by raising small rounds and cutting costs so that they can have a longer runway that lets them raise bigger rounds in 2024, hoping that the environment is going to be better and the ecosystem is going to grow again. Okay, so it's not just a downturn in terms of macroeconomics, but we have seen a true impact in the startups ecosystem. It is true that if you take a look into the numbers, VCs still have a lot of money to invest because VCs in the previous years have raised a lot of money by themselves from their LPs, but the money hasn't flown yet into startups. Okay, they are waiting for a more secure ecosystem or environment, I would say. Okay. Also, in terms of rounds, what we have seen is that it takes longer to close them with VCs because of these reasons. Okay, so there are more discussions in terms of valuation because funds are turning them down and startups are willing to have the same valuations they received before or the same multiples. So this is delaying operations. The average before, I would say it was 6 months, and in 2023 we can say that it increased to 9 months average. Okay, so this is important in terms of runway and calculating when I should raise the round, because a 3 months difference in a startup is a huge gap. Okay, so we have to always take this into consideration. Then a great change in terms of trends or dynamics is that funds are asking a lot for profitability. So in the previous years, what we saw is that funds were willing to give a lot of money for product development, for growing at any cost. And now what funds, or in 2023, what they have been asking for is not just profitability itself, but a path to profitability. Okay, I will deep dive here in the transport 2024, but spending money like crazy is not liked anymore. Okay, before it was like we don't even care as long as we grow or as long as we are the first one to develop the product. Now finance plays a bigger role. Okay, and they are looking to numbers quite more. And the conclusion from this that we can take is efficiency over growth. So let's spend the money wisely, not heavily. Okay. So let's see at what happened in 2023 in numbers. Again, the perspective from the VC will be covered on a deeper way next Tuesday with Jordi, but just to give you a few numbers so that you can see it. This is venture funding in 2023 compared to the previous years. So this is what I said. The money that has been invested by the VCs decreased a lot. 2021 was the peak, especially because 2020 was the COVID year. So investment decreased a lot. Then it skyrocketed in 2021. 2022 was an effect of normalization, I would say, so to compensate the huge increase in 2021. But last year was definitely a decrease in terms of investment and in terms of number of operations. Okay, if you compare it, it's a 42% decrease, which is a lot, especially in an ecosystem like startups and VCs, because the tendency in the previous years was a huge growth. Okay. This is what I said about one of the reasons that has delayed the closing of the rounds is longer discussions around valuations. So startups that raised funds in 2021 with valuations that were 20x, 30x over ARR, for example, for SaaS companies, are not willing to have their company valued in 2023 at 10x ARR, because it could be a down round, because they were expecting maybe same multiple over a biggest ARR. They don't want to be diluted, or it could be a matter of image, you know. It's like showing a down round can be really harmful for the company. So conversations around how much is the company worth is a reality, and you can see here how the multiples have decreased over the year. And this is a huge consequence in dilution for the founders, okay? And in the amount that the VCs are deploying in startups, because if you're willing to give me a lower valuation, then I'm gonna raise less, because I'm not willing to dilute that much, okay? And last, this is what I said about growth and profitability, okay? So funds are constantly asking, and we see this here every single day, because we have a relationship with the investors, because we at the end we report to the VCs, and it's a constant message from VCs: save your money, don't spend that much, cut costs, and try to be more efficient. Okay, this is just for you to have some insights about what we have seen in 2023. So let's go to what we can expect in 2024. Okay, so what are the main tendencies? First one, as I said, sustainable growth. It is important that we don't have to think anymore on achieving 5x, 6x growth, but rather with the money that I have to demonstrate a sustainable growth. Okay, so it is better to do 2x multiple in revenue compared to last year, but with a minus 100% EBITDA margin, than 4x with minus 1,000 EBITDA margin. Okay, before, I think that no one even looked at expenses. It was just a matter of growing. Now, be careful with how you're spending your money, because it is going to affect the valuation you're going to receive from the VC, or even if the VC is going to be interested in the business or not. Okay. Second one is quite related, is efficiency. So every euro counts. We have to spend them wisely. Okay. So we will see later the main KPIs that are going to help us track this, but the idea is every single euro that I'm giving to the company, what is giving me back on, or how much revenue is it generating? Okay, so we have to put our focus in being really analytical, and to try to put everything into numbers, and of course, having the possibility to measure everything in the company. Okay. Third one would be path to profitability. So, and this is what I said before, funds are asking not for profitability as of now in the startups, because I mean it's inherent for any startup, but rather how is the company gonna become a profitable company, or what are the mechanisms that the startup can activate in order to get profitable? Okay, it's a matter of forecasting and business plan. We see this on our day-to-day, because we need to work together with all of our clients on building business plans. And as I said, January is the month where all the business plans are approved by the boards, and this is what the team is saying every single day, that we have to show a business plan for like a 3 to 5 years plan where the company can become profitable. It doesn't mean that it is what is going to happen, but we have to build a scenario where we are able to make it happen. Okay. So the fourth one is keeping the tendency, I would say, that we saw in 23. In 23, it was hard to raise funds, and it is going to happen again in 2024. At least This is the visibility we can have in January. The first half is going to be tough. Again, we may see a lot of bridge rounds again, because startups have to survive. Looking forward into a second half or even into a 2025 where the market opens and there is more certainty to raise bigger rounds at higher valuations. Okay. And the last one, alternative financing. This is a consequence of the previous ones. So as it is getting harder to raise funds from VCs and to raise equity in general, what we are seeing is that startups are, and us here in the company, have to work a lot into getting financing from other sources. Okay, so here's where alternative financing is key. We have several, okay, and we're gonna cover them later. Okay, so just to support this message, this is what we can expect in terms of VC investments for 2024. Okay, it is from Q1 to Q3, but if you see is a tendency that follows 2023, that is a huge drop compared to 2020. Okay, so if you work in a startup of your founders or whatever, keep this in mind that we still have to cut costs and to expect low financing from VCs. Okay. So how can we tackle this? As I said, financing alternatives, we can find them out there. There are different agents willing to finance startups. So let's cover them one by one. First of all, we can find public funding. Okay. We operate in Spain and Germany mainly, but we have seen it in many countries. Governments are willing and are giving a lot of money to entrepreneurship, to innovation. There are several agents in each country. We also have tax incentives. So there is a lot of options to get money. It is true that it is hard to get it in terms of bureaucracy, applications, relationship with the public authorities, timings. So you can get big amounts of money, okay? And they can even be grants. But as I said, the applications are tedious. So in fact, we offer here at the Startup CFO a business line where we take all this bureaucracy from the startups because it is making up the reports. As I said, all the relationship with the public authorities is a lot of time, so it's time consuming. And if you have done it before, you may have seen that it takes a lot of time, not just in terms of number of iterations, but also how much time it consumes in terms of months. Okay, so considering this, you have also to take into account that the probability of getting this kind of financing may vary. Okay, may vary on the type of instrument. If you're applying to debt, to public debt, the probabilities are higher. If you're applying to grants, it is super hard to get it. Okay, because it is free money. So you have the best conditions you may have. There's nothing better than free money. And even for the public debt, conditions are quite good in terms of cost. Okay, so you have really good conditions, interest rates. You start paying the loan maybe 3 years after you get the money. Okay, but as I said, probabilities are not that good. Okay, what do we suggest our clients here, or what is our advice? Try to maximize it always, because we have seen a lot of clients surviving and getting financing from public authorities, both in terms of grants and loans. Plan it in advance with a lot of time, okay? every 6 months, yeah, two times a year, you can review the different options you have because there are a lot. And every now and then they issue new new grants or new programs for different it can be for different geographies, for different verticals. For example, now AI, of course, is fundable by anyone in the world. So just keep an eye on it and reach out if you want to know about them, because here we see a lot of them. Okay. When you're planning your cash and your business plan, don't count on it, okay? If it is not extremely certain that you're gonna get it, okay? If you don't have the approval signed by the minister, like, don't count on it, because not because you're not gonna get it, you may get it, but you don't know when. So if you're gonna break cash in 4 or 5 months and you're planning 3 months of runway extra on top of that, just because you're getting public funding, don't count on it, because it may come in 6 to 8 months and then you're dead. Okay. Apart from public funding, you have bank funding. Okay, this is the traditional funding that we have seen for companies all over the time. Historically, banks haven't funded startups. This is the truth. But in the last years, we have seen that they have opened teams inside the banks. They have opened financing for banks. We see many more operations now than we did years ago. And each year we see new banks that are opening offices or branches just for startups. Okay. For example, in Spain at the beginning, it was just Sabadell Caixa that were two banks. Now Santander and BBVA are going quite hard on startups too. Okay, so it is a thing. Conditions are quite good. Requests are much easier than public funding. Okay, so they're gonna analyze your financials. They're gonna ask for the business plan. They're gonna ask for what are you gonna, like, how are you gonna spend the money? But timings are quite shorter. Analysis is much simpler. And then it goes to risks department and they give you an answer quite fast. Okay. The debt you get from banks is usually senior. This means that they have priority over the rest of debt you may have in the company. So they're first one to collect. Okay. Of course, the last ones are the investors. As I said, conditions are good, relatively cheap as of now. We will see in 2024. We expect that interest rates can decrease a bit compared to what they are now. Of course, nothing to do what we have seen in the last years with rates in 0%. But that was an abnormal situation. Okay, so as of now, the conditions are still relatively good. And as I said, what they analyze is financials, business plan, but it is still an old-fashioned analysis. Like, banks, if they see a P&L that is losing money, they're gonna freak out. Or they see a balance sheet that is not that big because a startup doesn't have huge assets. They're gonna say, like, what is happening here? What is going on? Okay. So they're working on it. They have improved a lot in the way they look at startups, but still you will find that they don't have the same vocabulary that a venture capital firm could have. Okay. So what is our advice regarding bank funding? Again, as with public funding, try to maximize it. The thing is that it is hard to get because banks are assuming a huge risk when financing a startup. Because if you think it from their side, they're giving money to a super risky business, and they're not gonna get back that huge amount of money like a VC would do. So they cannot make mistakes. A VC is willing to have one company that returns the whole fund. A bank cannot tolerate failure in more than 2-3 operations over a 100 startups portfolio. Okay, so they're not stupid. They're gonna be tough in terms of choosing what startups they're gonna fund. Never endorse with personal guarantees. You're not willing to compromise your personal assets or your personal lives for this. The startup itself is quite risky. You're spending your time and your money. Don't add additional liabilities from your side. Okay. Then we recommend to establish relationships with several banks at the same time. Okay. Because if you only have one bank and you're willing to get financing from 3 or 4, starting the whole conversation from zero is going to take a lot of time. And if you already have accounts open and activity going on, then it's going to be much easier. Okay. Then try to raise money from banks, negotiating and signing at the same time. Okay. If you go one by one, then you're going to be accumulating debt in your balances that are going to be analyzed by the following one. So try to do it simultaneously so that you get all the funding at the same time. The best moment to raise funds from banks is just after a round. This is because, I mean, it may sound absurd, but it's when you have money, and banks are going to give you money when you don't need it. When you need it, you're not gonna get it because it is too risky for them to give you money when you have 6 months runway. Okay. Try to negotiate long terms. Okay, you will usually get from banks 3 to 5 years period. But we'll try to extend it as much as possible. And it is important that if it weren't for the CFO, and we see that here every single day, the CEO would only think about getting bank funding when they have the money. This is what I said before. So try to raise it just after the round. Okay. Another source of funding is venture debt. Okay. I'm not gonna get into details because it is a quite complex instrument. It is hybrid between debt and equity. You have the loan component as you can have in bank debt, but you also have the equity component because you're gonna have conversion of an amount of the money they invested. So it's a combination of VC and a normal loan. The only thing is that they are converting less money than what they invested compared to a VC, but the cost is going to be much higher than what you can get from a bank, okay, in terms of loan. They usually give large amounts, okay, they are comparable to a VC, not to banks. Banks are going to give you small money, but you can raise big amounts with venture debt. But the process is as raising equity. Okay, you have the due diligence, you have the negotiations, it is quite similar. And the contracts are really complex, okay? It is not as standardized as you may see, of course, in loans or even in equity. As here you have the combination of different factors, contracts can be extremely complex, okay? So what is our advice here? As I said, super complex, so it is not that easy to get it closed. You have to think about it as a funding round, okay? So it's gonna take time. You're gonna go under a due diligence. You're gonna have to negotiate, so it takes time. Try to get as much information as you can from the different agents you're negotiating with. Talk to other CFOs that have iterated with them or have raised funds from them. And it is the only alternative that you can have to financing round in terms of amounts, okay? Because you can get, if you raise, imagine 3 million in equity, you can get another 1.5 million in venture debt. That is not gonna happen with any other kind of financing, okay? And last but not least, revenue-based funding. So this is something that has grown lately a lot. It is adapted to startups. I'm not gonna give all the details because it can get a bit complex too as venture debt. But the idea is I give you an amount of money, imagine 1 million, and you're gonna repay that million based on how much money you're able to generate in revenue. Okay, so it is not a fixed repayment as you may see in a loan. It is based on the company's performance. So if the company goes well, then you're gonna repay a lot. But if the company is not performing that well, it alleviates your cash position because you're not gonna repay the loan as fast as you may. So it is not risky because of this reason. Okay, it is quite flexible. To the question if it's expensive or cheap, it is gonna depend, as I said, on how the company is performing. If the company performs well, then it's gonna be expensive, and the other way around. But it is a good problem to have. Okay, you can get big amounts of money, of course, not as venture debt or VC, but somewhere in between bank funding and venture debt. They may restrict what you use the money for, okay? So some of them are only allowing you to pay marketing campaigns or ads with the money they give you. And this is more an admin finance matter, but it is not that easy to account, okay? In terms of bookkeeping or account, okay? So, what is our advice here? You can get big money relatively quite easily and fast. Okay, the analysis is super fast. It is not old-fashioned as in banks. They're gonna speak to you about KPIs, about ARR. So, it is a good alternative, non-diluted, by the way, because venture debt. Remember that you're giving up a bit of equity. When to apply is key. Okay, so you have to show growth, you have to show a relatively comfortable cash position to get this financing, minimum 6 months of runway, I would say. It may give you the option to delay your next funding round because you have a compound effect because it is like a credit line. So when you repay, you again have the possibility to retake that money. So you can extend your runway a lot and delay the funding round if the company performs well. Okay, it is quite expensive, depending on which instrument. For example, CapChase, that is fixed repayments. We can say it is expensive if you analyze the IRR, but they're gonna give you big money, so it may be worth it. Okay, we have seen it a lot in our clients, and it has saved us from some problems, and we have been able to delay some rounds. Okay, relevant KPIs to track. So, with all that we have said in mind, it is important to know how we can track the company, both to see how we're doing and both and also to see what we have to show to the funds when we are raising money. Okay, so first of all, ARR growth. This is classic one, an easy one. How much is growing my ARR from current moment compared to a specific moment in time? Usually, we want to analyze month-over-month growth and year-over-year growth. Okay. Then net retention. This is key in SaaS companies. Net retention is going to allow you to understand how would your company perform if you didn't get new clients. Okay, so the base of clients that I have in a specific moment, how is it evolving over time with upsells, downsells, and churns? Okay, if you have net retention over 100%, then the business is quite good. The best you could have would be 120, 130. Okay, over that, it's crazy. And be careful if you are below 90%. Okay, because it means that you're losing MRR above what you should. Okay. Then ARPA is average revenue per account. It is basically dividing ARR by the number of accounts, but this is gonna let you understand the average ticket that you have in the company. Okay, and the tendency it follows, if it goes up or if it goes down. Then lifetime value, how much revenue are we able to generate or to bring from a single customer over its whole lifetime? Okay, so this is basically your ACV, so average ticket analyzed, times the gross margin times the lifetime in years in this case. So if a client is with us 2.5 years, how much money am I able to generate in those 2.5 years? Okay. And last one in terms of growth is ARR at maturity. This is the maximum ARR that a company can achieve. Okay, so if the company reaches maturity in terms of business, what is the maximum ARR I can look into? So this is how many clients I am able to get every month times the ticket times the lifetime. Okay, because if I'm getting 4 clients a month over 2 years lifetime, it means that in 2 years I'm gonna be losing those 4 clients per month. Okay, so this is how much can I achieve as a maximum. Then in terms of efficiency, we have divided this in 2 areas, company efficiency and then sales efficiency. So in terms of company efficiency, it is how am I spending the money compared to growth and revenue. Okay, so first of all, rule of 40, this is the combination between my revenue growth rate and my profit margin. If it's higher than 40%, it is a good indicator. Okay, if it's below, then you have some problems in the company. What does this mean? If I am growing at 100% rate, okay, and I have a negative net result of minus 50%, then I'm above that 40%. Okay, so it's 50 the result. If I'm growing at a 200% rate, that seems better than the previous example, but I'm losing minus 200%, then the net effect is 0. So the money I'm spending is not worth the growth I'm achieving. Okay. Next one is the burn multiple. Okay, this is how much money am I generating compared to the money I'm burning in that period. Okay, so net new ARR basically divided by the net burn of the company. And then contributions margin. I really like to look into this when I'm analyzing P&Ls because it lets you understand at which point of the company's costs the company starts to be non-profitable. So if I have a gross margin of imagine 90% as a SaaS company, if I take out operations and customer support, what is my margin now? 50%? Okay. If I take out sales and marketing, then I'm 10%. So now if I take out my development team, then that is where I get unprofitable. Okay, so it is important to understand how my costs support my revenue generation. Okay, in terms of sales efficiency, we have 2 main KPIs here. The first one is the magic number. So this gives us for each dollar that I invest in sales and marketing, how much revenue am I generating? Okay, so if I'm able to generate $2 by each dollar I invest, okay, the business is worth it. Because if I lose money for each euro I spend just in acquisition, then I shouldn't be focusing on getting new clients, but rather on the service I'm providing or the product delivery. Okay, and then the CAC, the analysis is quite similar, but it's not measuring it in euros or in dollars, but rather in number of bookings. Okay, so for the money I spend, and how many accounts am I closing per month, I have to get to how much does it cost to get a new client for the company. Okay, this is what you have to compare to your lifetime value to understand if the money that my customers are bringing to the company is worth what I spend on acquiring those clients. So next point is about the finance team structure. This is key for us in the company in order to explain our services and in order to structure the tasks internally. And this is how any finance team in the world operates, okay? Not just in startups, but in any company. So first of all, you have the CFO at the top. It's a pyramid. You have the CFO on the top that is in charge of the, first of all, supervising that everything that falls under the pyramid is in order and is working. The CFO focuses on forward thinking, focuses on strategy, on pricing, on advising the CEO, investor relations, capital management. So it's more a value-added area and support to the management and to the CEO. Okay, and externally, it affects in investor relations. Then under the CFO, you have two blocks: financial planning and analysis and controlling. They're at the same level because both of them fall under the CFO and there is no hierarchy between them. Okay, but they work really closely. Financial planning and analysis is based on forecasting and reporting. Okay, so it's the owner of the financial model and the cash management. This is our day-to-day here, okay? We're constantly analyzing the numbers, both from a reporting and a forecast point of view, making changes constantly to see what measures we can take, what we can improve, identifying the risks that we see in the startups, etc. Okay, and then the controlling area is like a soldier for the CFO. Okay, the controlling is in charge of making things happen from many different angles. Okay, if you take the list of tasks that falls under controlling, it is huge. But it's a matter of process optimization, managing relationship with third parties, providing information, ensuring that what falls under controlling an FP&A in the pyramid that we will see later, that is accounting and bookkeeping, works properly, that the numbers that get to FP&A and CFO are accurate. So it is the area that is in charge of making things happen. Okay. And then the base of the pyramid is accounting and bookkeeping. Okay. Accounting is ensuring that all the entries in the ERP are correct. Okay. It is overseeing that the numbers make sense, that the accounting items that could be complex are addressed properly, that there is a chart of accounts that makes it easy to understand the numbers and that they are properly organized, filing taxes. So it's a role of supervision and accuracy, okay? Bookkeeping is a matter of manual procedures of getting information into the ERP, okay? It is recording transactions and that's it. But it's important to have all the information ready in the systems so that the rest of the levels in the pyramid can do their job, okay? And outside the pyramid, you will find pre-accounting. That is a matter of sending and receiving invoices and making and receiving payments, okay? So, best practices. It is important to differentiate financial versus management reporting. Okay, financial, it is purely accounting. Okay, so it's what the ERP delivers strictly. They're grouped by accounts, following the chart of accounts that I said before. It depends on the different standards and regulations you can find in the different countries. US GAAP in the USA, Plan General Contable is how we call it in Spain. You have to follow certain rules. Okay. It is meant for third parties mainly, okay, so for tax authorities, banks, and it is compulsory to have it, and it is official, so it has like a guarantee that those numbers are official. On the other side, the management accounts are thought to make an analysis, to get to conclusions, to have some insights on the company. The input is not just accounting, but also business, okay, and KPIs related to the revenue, to the clients, etc. And they're usually grouped by dimensions so that you can analyze numbers from different points of view. They could be specific by company. Okay, so the idea here is to understand the dynamics of the business itself. So depending on the business model, you can have completely different management accounts. Okay, with different revenue streams, with different cost of sales, etc. It is intended for management and shareholders. Okay, so as I said, it is an instrument for making decisions, and they are unofficial. Okay, so no one have to approve that those management accounts are okay or not. Okay. Financial reporting preparation. So how do we get to the management accounts in terms of reporting? Okay. It is basically converting all those ERP entries that come from bank information, invoices, and several movements into financial statements. Okay. Once you have those financial statements, you have to build the structure on building on getting into the reporting. Okay, so the process would be you get the direct access to all the information so that you have the ERP entries. Okay, of course, monthly, because in a startup you have to make decisions fast and you have to get information as soon as possible on a monthly basis. Quarterly is not going to give you insights enough. Review that there is no missing information. Try to, as I said, try to get it as soon as possible with quick pre-closings and requests. Like you have to iterate a lot to get to the accurate numbers. Okay. Then a final review of the statements to ensure that everything is okay. And then you can do all the reporting elaboration. Okay. When you get into the management reporting, you have to combine these financial statements with business. Okay. So it is important to get to actionable information, to get to key insights for the management. You can, as I said before, you can split it in different dimensions by business lines, by geographies, whatever is useful for the management team to do a thorough analysis. Okay. It keeps track of accounting metrics. This is the one that we saw before, together with many more in terms of pipeline, sales, funnel, whatever. But it is business driven, not accounting driven. Okay. And it is important that you understand that this is what makes you make the proper decisions and what moves everything in the company. Okay. So key insights that I would want you to take from today's session is always keep an eye on cash. Okay, especially now that it's hard to raise funds, you have to keep track of your cash position, estimated runway, how much am I burning on a monthly basis, and how much do I expect to burn in the future. Never rely on public financing, as I said before, because it is unpredictable in terms of timings and maybe in terms of amounts. Okay. Financing rounds can be delayed in time, especially now with what we have covered in the webinar session. Cash versus P&L. Don't make the mistake of assuming that revenue is money coming into your account and that costs are payments. Okay, because you have taxes on top, because you may have quarterly payments, for example, in retentions, because you can have long cycles of collection from your clients. So be careful on when you get the money and when you have the revenue and the costs. Okay. Then always connect reporting to forecast. This is really important for the company because you have to rely your projections on what you have seen in the past. Okay, because if not, the starting point makes no sense. So always keep a track on forecasting based on what you are seeing on a monthly basis. Okay, and last of all, reality metrics. Okay, this is put the focus on analyzing what is worth for the company. Don't rely on metrics that are nice to see but means nothing for you, because then you're gonna get to the wrong decisions. Okay. So this is all from my side. I leave Jaime to present in this last 5 minutes academy and to explain better. Okay. Any questions you may have, of course, feel free to reach out offline via LinkedIn or wherever. I'm happy to help. Okay.
Yeah. Well, if you guys have like any questions now regarding like any particular topic, I think we would have time maybe for one. So happy to take it, or if you guys write it on the chat or anything, or if not, as Jubi said, write to either Juvenal at tscfo.com or Jaime at tscfo.com, and we guys are happy to answer it. So let me share screen, and I will tell you a bit about our academy program. So yeah, here it is. So our academy program, we have been doing already 7 editions, as I was saying before, and it's a course designed to teach startup finance. So all the basics on startup finance, from business modeling to anything related to funding, both alternatives of funding or big focus on the funding rounds. It's actually 2 whole lessons in the program. And there's also one on venture capital. So the objectives, as we say here, is master the tools needed to understand startup finance, understand financing alternatives, design robust reporting, modeling. It's if you want to take it that way, if you want to focus on the Excel part, it's also a good course to learn modeling, deep dive in financing rounds, and of course create a pretty good contact network. In fact, we have had around 400 alumni already, and yeah, like from 10 nationalities. So pretty good network that we have. The structure of the course is completely online. It's 10 weeks. And in fact, we are starting with the introductory session next Tuesday, but then the live weeks, the live sessions that we're going to have on a weekly basis for lesson 1, lesson 2, and so on, will start in Thursday, February 1st, and the first live session in February 22nd, and the last one at the end of April. It's in English, the format online, as I was saying, and all the lessons are divided of around 1 hour of theory in pre-recorded videos, 1 hour of your own time to solve a practical case, to learn more from practical cases of real startups, and 1 hour of a live session. That, as I was saying, for lesson 1, for example, is February 22nd. The price is 1,400 euros and 50. But if you guys write webinar on the type form that you will find in our website, if you go to our website, you will find the academy link, and then you write like, how did you know us? If you write a webinar, you guys can have a 15% discount, and it's payable in 3 different monthly installments. So if you're thinking like, is this for me or not? Then the community like that we have to see if you guys are identified is either CEOs or top management of early stage startups. Actually, it's 50% of our alumni are CEOs or COOs or even CTOs of early stage startups. That definitely the startup finance can't be a black box for them. Also, if you work yourself, obviously, in startup finance, and you want to learn for your own daily work, we have had a lot of profiles from corporate auditors, consultants, people of private equity, banks, Google. Actually, we have a ton of alumni from Google, so that they want to train or think about changing towards a startup. Then investors, either venture capital or business angels themselves, of course, or in general, people that are passionate about a startup and venture capital ecosystem. The course is taught by me, by Luisfer, who is a manager in McKinsey, and by Jubi as well. And well, on the lessons, actually, let me give you this summary here that we see all of them combined. So introductory, then SaaS platforms and other business models to understand really well those business models, a lesson on reporting, and then the second block of the course, much more focused on funding alternatives, funding rounds, and introduction to venture capital. So the first block is more on the business models, the second one on the fund. We also have a course on venture capital that is focused on how VC works and how the VC dynamics work in itself. But the next edition starts in September. So you guys can take a look at the website of all the materials and stuff. But it's a longer time from now. If you guys pre-register for either one of the courses, we will send you more information, and we'll be happy to take any doubt or any question you may have by email or even by a call. You guys can also ask for references of previous alumni, whatever you guys need. So thank you guys for joining for this session. It was great to have you. We will also, by the way, post it in YouTube, such that in our YouTube channel you can see all of our previous materials actually. And yep, hope to see you around. Hope to see you either in the course or in the next webinar next Tuesday. So, thank you again.